I get the question a lot, what is investment banking? I've been lucky enough to be in the industry for the last 25 years, so hopefully I can explain it in easy to understand terms. Investment banking is advising companies or governments on raising capital, whether that's equity or debt, or completing mergers and acquisitions. So let's look at those three components. There's mergers and acquisitions, or M&A and restructuring. There's equity capital markets, which covers off raising equity. And there's debt capital markets and high yield capital markets that covers off raising debt. Let's dig into each of those for a minute here. Mergers and acquisitions, or M&A, is what my current company does. We specialize in doing it just for the technology industry, but there's mergers and acquisition advisors for multiple industries across the whole economy. As the name implies, it's mergers, which is combining two companies, or acquisitions where a bigger company buys a smaller company. A lot of the investment banks also include restructuring in their mergers and acquisitions group, and this might be either spinning off a subsidiary of a bigger company, or restructuring a company out of bankruptcy, or restructuring their debt. To make things a little bit more confusing, M&A is often talked about in terms of being either on the sell side or the buy side. In an M&A transaction, if you're on the sell side, you're representing the seller. If you're on the buy side, you're representing the buyer. And it's usually not possible to represent both sides. You have to kind of pick either the buyer or the seller that you're going to represent. And how do the investment banks make money? On M&A deals, they normally get a percentage of the transaction. So the larger the transaction, the smaller the percentage will be. Now on to equity capital markets. Equity capital markets usually consist of three things: initial public offerings, follow-on offerings, and convertible bonds. Initial public offerings is taking a company that is not public on the stock market, so listing that security so that it's freely tradable on the stock market. Follow-on offerings is similar to an IPO in that you sell equity in that company, but the company is already public and already traded on the exchanges. And then convertible bonds is a combination of debt and equity. It's usually a bond with an option to purchase the equity or to convert into the equity. Debt capital markets is essentially raising debt for companies, very similar to what equity capital markets is, but on the debt side of things. And it's typically broken down into two components: debt capital markets, which is usually for the investment grade companies, so the higher credit rating quality companies, and high yield capital markets, which is for the non-investment grade companies, so the companies typically that have not as good credit metrics or have more leverage. And similar to both M&A and equity capital markets, debt capital markets and high yield capital markets typically get paid a percentage of the transaction value. I hope that was a useful outline of the different components of investment banking. In future videos, I'll be actually breaking down and spending a little bit more time on each of those three components. So I'll be bringing out an individual video on mergers and acquisitions, equity capital markets, and debt capital markets. If you like the content, please subscribe, and definitely if you have any comments or questions, put them in the comments below.